Here's why Vanguard has basically destroyed everyone's investing expectations for the next 10 years.
What is your thinking on that? Why?
According to their most recent report on the economic and market outlook for 2024, Vanguard predicts that we'll all make a lot less money in the stock market moving forward.
So you're essentially saying that stock market returns will be below normal for the next several years.
So let's delve into why they're making these predictions, and I'll share my thoughts on what this means for us at the end of the video. First things first, let's talk about their forecast on interest rates and the impact that this have had on the global economy. To put it simply, Vanguard predicts that interest rates will stay higher than what we've been used to since the 2008 financial crisis. They basically believe that we're not going to go back to the days of cheap money, where you could get a mortgage with a 2% rate. Instead, interest rates are going to stay higher for longer. This means that borrowing money will cost more, but saving money will earn more. However, they think that this change will ultimately be good for investors in the long run, as higher interest rates mean investors will have more options beyond the stock market, such as bonds or even just keeping your money in a savings account. For example, if you have cash to invest, one option right now might be to save it for a guaranteed rate of 5%. Another option is to invest it in the stock market, which carries more risk, but the reward over long periods of time tends to be much better. So you can see why this could be a difficult choice. Now, although investing in the stock market can give you much higher returns in the long run, we all know that in any given year, anything can happen. In fact, this Vanguard article titled "Why Stock Market Returns Are Anything But Average" highlights this point very well. For example, as you can see from this chart, global shares, as represented by the FTSE All-World Index, have delivered an average annual return since 1993 of 9.3% in sterling terms, but have rarely delivered anything like that in any given year. In 2022, for example, shares fell by 7.3%. While the year before they rose by 20%. So sure, shares tend to bounce around more than bonds and cash, but they also tend to return more over time. However, you can understand why Vanguard is saying that there is now more choice for investors. With returns on cash of 5.25%, it can be easy to compare a negative return in a single year in the stock market with the returns available on cash. This could mean that if more people choose cash and bonds over stocks, stock prices could decrease because companies listed on the stock market might not appear as attractive to investors when interest rates are high. Okay, let's move on to bonds, because according to Vanguard, bonds are back in town. Vanguard thinks that this rise in interest rates that we've been seeing lately is the single best economic and financial development in 20 years for long-term investors. They now expect UK bonds to return an annualized 4.4 to 5.4% over the next decade, compared with the 0.8 to 1.8% annualized returns we expected before the rate hiking cycle began. Keep in mind that this is before you take inflation into account. Similarly, for global bonds, excluding those in the UK, they expect annualized returns of 4.5 to 5.5% over the next 10 years. So the main investment that is meant to protect your investment portfolio from market crashes and give you a bit more stability sounds more appealing now than ever. Now, with bonds looking more attractive over the next 10 years, Vanguard believes that the case for the traditional 60-40 portfolio, where 60% is in stocks and 40% in bonds, is stronger than in recent years. For long-term investors, this could mean generating returns of 7% per year, while also providing a bit more protection from the volatility typically associated with the 100% stock portfolio. This actually sounds promising, so I guess that only time will tell if it pans out as expected. I'm sure many people will be happy to see their portfolio grow at a 7% annual return, but for much less volatility. The bottom line here is that over the next 10 years, Vanguard expects the difference in returns between investing in global stocks and global bonds to be small, ranging from 0 to 2% percentage points per year. This is different from the previous decade, where stocks often performed much better than bonds. They believe that this change will result in more balanced investment outcomes for diversified investors, as both stocks and bonds are expected to deliver more similar returns. Bonds are an interesting concept, especially for young investors. You hear everyone saying that as a young investor with a lot of years ahead of you to invest, you shouldn't even be thinking about holding bonds and going all in on stocks. But there is also a psychological side to holding bonds. Think about it, with 100% stocks, it does feel like we are on a roller coaster. and many people just can't stomach a 50% drop, despite the fact that they have years ahead of them to ride out these market fluctuations. So sure, adding bonds to your portfolio may mean lower returns, but it could also make you feel more in control of your investments. Alright, let's dive into what you've all been waiting for: Vanguard's stock market expectations. But just before we continue, don't forget to hit that subscribe button if you haven't already. Thank you. Looking at this data, Vanguard has analyzed different parts of the stock market and provided their opinions on whether they believe each segment is undervalued, fairly valued, or overvalued. As shown in this chart, they believe that most of the stock market is overvalued at the moment, with US stocks being particularly overvalued. Additionally, they believe that UK stocks are somewhat overpriced, although not as significantly as other areas. This chart also illustrates how valuations have shifted over the past year, reflecting changes in their model. Comparing the current data with their models from a year ago, which is shown by the white circles, it's quite clear that most areas have become more inflated. However, they identify two areas with potential value: emerging markets and US small caps. There is no secret that emerging markets and small cap stocks are areas of potential growth. This is a known fact in the investing world. The challenge lies in timing, particularly with the dominance of large US stocks which have been steadily gaining strength. In terms of what this means for actual returns over the next decade, you can see here that they expect US stocks to only return between 4.1 to 6.1%. They also project 10-year annualized returns of 6.8% to 8.8% for non-US developed market equities, 4.7% to 6.7% for UK equities, and 6.4% to 8.4% for emerging market equities. Now, these numbers don't seem that discouraging, but the problem here is that many people who've started investing in the last couple of years were promised returns of 10 to 12% per year. In fact, when asked about what they expected their returns to be for the long term, on average, investors expect a return of almost 13% per year, above inflation. So not just 13% returns, they want that on top of inflation. So it appears that after more than a decade of outsized returns, investors have been conditioned to expect high returns from the stock market. This survey was published a few years ago, just as many people were starting to explore investing in the stock market, having found themselves with disposable income due to the pandemic. There is nothing wrong with being optimistic about the future. The problem is that many people are planning their future financial lives based on certain misbeliefs about how markets will perform, and as a result are putting too little into their investment pots. On top of that, while returns of 10 to 12% per year sound good, people forget about inflation. The real return of your investment is likely to be much lower than what you're expecting, so keep that in mind. Now, after considering all these predictions about the future, can we truly rely on this analysis, and does it really make a difference? Well, I did a bit of digging and I managed to find some forecasts made by Vanguard in the past. For example, in this report published in 2010, their prediction looked like approximately 9% for the US market and approximately 10% for international markets. However, in reality, the inflation-adjusted returns over those 10 years on the US market were 13.47% and on the international markets 5.76%. Then in 2014, they said that 10-year returns of a global equity portfolio are centered in the 5% to 8% range. But in reality, global equities return more like 14% per year on average. And in 2015, they said global equities were going to return in the 6 to 8% range. And again, looking at the global equity index funds such as VWRL, we actually saw returns of about 10%. It's worth saying that just because these predictions turned out to be wrong doesn't mean that they were bad predictions. They were good predictions given the information at the time, but they couldn't have predicted everything that has happened since then. Now, I tried to look at this objectively and ask myself, where does the majority of the money go? The biggest answer seems to be US stocks. Every year since the global financial crisis, the S&P 500 has had positive returns. Except for 4 to 5 negative years, it has returned 10 to 30% annually. I understand that valuations, especially in the US, are quite high.
The primary driver, Bob, has really been around valuation, right?
And we're not returning to 0% interest rates anytime soon. But lowering future performance expectations for the next 10 years to 4.1 to 6.1%, I just can't imagine that happening. I have trouble seeing how the slower international economies will generate higher stock returns when so much of the investment money is going into the still rapidly growing tech sector, which is primarily in the US. Plus, with ongoing advancements like AI, the tech sector is expected to keep growing strong. I love Vanguard as much as anyone. However, they've been saying this for a decade or more. They've predicted that international stocks will outperform US stocks and that the US market is overvalued and will underperform for so long now. They aren't wrong to think that, I get it, but they've also been wrong every single year. So my conclusion is simple. As a long-term investor, I stick to my plan. I maintain a well-diversified global portfolio, keep my costs low, and invest consistently every month to make sure that I will have enough money in my retirement account when the time comes. Because we all know that we shouldn't rely on our state pension alone to fund our retirement lifestyle and should take steps to build our personal retirement accounts too. In fact, given that the UK is facing a major pension crisis, this is more important now than ever. So check out this video next to learn why many people will probably never be able to retire.